All right, today we're cracking open a deep dive financial analysis on a company called HDB Financial Services. We're going to see exactly how the pros try to separate a potential big winner from the rest of the pack. We'll look at the good, the bad, and the final call.
So here's the big question, right? In a super crowded market, how do financial analysts actually pinpoint a potential winner? In this breakdown, we're going to see how one report does just that by going deep on one specific company. And you know it's all about the numbers, so let's start with a few really important ones.
First up, this number, 28.4%. So what is that? Well, that's HDFC's year-over-year growth in what's called assets under management. You can just think of it as how fast their loan business is growing. And believe me, a number this big, it's a massive signal that they're in high demand.
Okay, next we have 18.2%. This is their return on equity. Basically, it tells you how good they are at making money from the money shareholders have invested. And yeah, anything over 18%, that's a really, really solid performance.
And to round it out, 9.8%. This is their net interest margin, and it's all about the core profitability of their main business, lending. So you take these three numbers together, right? What you get is a really compelling picture. Right out of the gate, we're talking high growth, great profitability, and serious efficiency.
All right, so who is this company posting these kinds of numbers? Let's get into it. Here's the profile on HDB Financial Services.
So HDB Financial Services, or HDBFS, is a pretty big deal in India's financial world. You can think of them as the fast-growing lending arm of a true giant, HDFC Bank, which is one of the most trusted names in the country. Their bread and butter? Loans for regular people and small businesses. You know, a super important and growing slice of the economy. Okay, so what's got analysts so excited about HDFS? This is where we get into what they call the bull case. Basically, all the reasons to be really optimistic about the company.
The analysis from Web Cornucopia really breaks down a few key strengths. First, that connection to HDFC Bank is huge. It gives them instant credibility and, maybe more importantly, access to cheaper money. We've already touched on their awesome profitability and growth, but what's driving it? Well, they're going big on digital, they have a massive network all over India, and the people running the show really know what they're doing. It's a pretty powerful mix.
But, you know, a company doesn't exist in a vacuum. How do they look compared to their competition? This is where it gets really interesting. If you look at the PE ratio, that's a key way to value a company. HDFS is sitting at just 6.35, while its competitors are averaging over 15. I mean, that suggests it could be seriously undervalued. And at the same time, its profitability and growth are higher than the average. So they look cheaper, more profitable, and they're growing faster. That's the trifecta.
Yeah, and this chart just drives that growth story home. Look at that. HDFC is growing its loan business by almost 29%, blowing past the industry average of around 22%. This means they're not just riding a wave, they're actively taking market share, grabbing a bigger piece of the pie for themselves.
And the report just nails this point with this quote about the company's strong scalability potential. What does that actually mean? It boils down to three things. They're using tech smartly, their processes are consistent, and they're really efficient with their money. The big takeaway here is that their growth isn't just luck. It's built into their system. It's engineered.
All right, so the bull case is looking pretty airtight, right? Almost too good to be true. And that's exactly when a good analyst has to step back and ask the hard question. What could go wrong here? What's the catch? What's on the other side of this very shiny coin?
And that leads us right into the bear case. Because a thorough analysis always has to look at the risks, the things that could poke holes in that beautiful, rosy picture.
And check this out, because this is a fascinating little paradox the analysis points out. Their single biggest strength, that connection to HDFC Bank, is also flagged as a major risk, a key dependency. Sure, it gets them cheap funding and a brand everyone trusts, but relying too much on your parent company can be a huge vulnerability. It's kind of like having all your eggs in one very powerful basket.
And the report doesn't just stop there. It digs into some other big risks. You've got intense competition coming from everywhere, the old school banks and these new scrappy fintech companies. Then there's always the risk of new government regulations that could drive up costs. And finally, because they're so focused on loans to regular people, they're pretty exposed if the economy takes a hit and people stop spending.
But even with all those risks, the analysis points to a really important number that shows their stability, the capital adequacy ratio, or CAR. The easiest way to think about this is like a financial safety cushion. Regulators say you have to have a cushion of a certain size. Well, at 18.3%, HDFS's cushion is way, way bigger than the minimum required. It's a pretty strong buffer against any unexpected problems.
Okay, so we've looked at the good, the bad, the bull case, the bear case. Now it's time to see where the chips fall. Let's get to the analyst's final verdict after weighing everything.
So analysts don't just guess. They build these detailed models to figure out where a stock price might go. And this report lays out 3 possible scenarios. You've got the bear case if things don't go so well, which puts the price at around $13.80. Then there's the base case, the most likely outcome, at $16.80. And finally, the bull case, the super optimistic one, sees it hitting $19.50. Seeing this whole range gives you a much better feel for the possibilities.
And to get to a final score, Web Cornucopia uses its own special scoring system, and you can see how they weight things. Financial health and growth prospects, those are the heavy hitters, each making up a quarter of the total score. Then you've got their competitive position, the quality of their management, and finally, the valuation. So after all that number crunching and analysis, what's the final score? It comes in at a 7.9 out of 10. Now, in their system, that gives HDBFS a rating of proficient. Basically, it means this is a solid company with a strong foundation.
And this all boils down to one thing, right? The bottom line. The report's official recommendation is a buy, with a 12-month price target of 1,680 rupees. That's their call.
And this last quote from the report really just wraps the whole thing up in a neat little bow. It calls HDBFS a compelling investment opportunity, and it all comes back to those 3 things: the strong parent company, the solid and improving financials, and a price tag that looks pretty attractive when you stack it up against the competition.
And that really leaves us with the core question at the heart of this whole analysis, doesn't it? It's the big thing any investor would have to grapple with here. When you look at a company so tied to a powerful parent, is that a safety net that lets you sleep at night, or is it a single point of failure, a critical dependency that should keep you up? That's the tension. That's the big idea to think about. Thanks for tuning in.